Okay, let's start. So in the previous slide, you saw that cost of equity is increasing in debt to equity ratio. So as you increase debt, cost of equity will increase. Now I want you to be able to see where this cost of equity comes from, basically, how leverage affects cost of equity. And for that, we're going to use some asset pricing model. And most commonly known one is CAPM. We're going to link our knowledge to CAPM. So I'm going to talk about beta a little bit. Do you remember what beta was? What was beta? Yes. We always ask this in the graduate study interviews. What is beta? What is beta? In what sense? It's risk.
In terms of the whole market. If it moves like if marketing is 1%, but our stock increase 2%, beta becomes 2 because of this.
Perfect. It's like music. Yes. So basically, it is how your stock moves when the market moves. So if the market moves by 1%, and if your stock moves by 2% as a response, then the beta will be 2% over 1%, which is 2. So this is basically how the covariance of your stock with the market, basically. And in beta, we have different kinds of information, but we have two main kinds of information. One is the business risk or operating risk. Business risk is the riskiness of the company irrelevant of the capital structure. Can you give me a business risk example? Okay. Suppose that we are comparing a retail apparel company to a utility company. Which one has a more forecasted sale? Utility, right? It's more the sales are more stable. For retail apparel, we have other factors that will affect the riskiness of the company or sales of the company. Like what? Like what happens in the fashion industry will affect how much sale you're going to make. Or if input prices changes, are you going to be able to decrease or increase the price of your product? Is another business risk. So any factor that is related to the riskiness of the business, nothing about leverage or capital structure, is about business risk. In the financial risk, it's financial risk. So how leverage will affect the return. And you already we already saw that leverage affects the company different in good times than in bad times. So riskiness will also, riskiness of the financing source will affect the beta of the company. And together, when we think about financing sources, we have equity beta or we have debt beta. Debt beta is generally assumed to be 0. But together, they're going to form asset beta. Okay? And the way you write asset beta is similar to weighted average cost of capital. So it's basically the weight of debt times beta of debt times weight of equity times beta of equity. So together, they're going to show you the asset beta. Since we're interested in cost of equity, I'm going to focus on equity beta, basically. And this is how we can write equity beta. The idea is the same. I don't have to go in middle steps because it's just algebra. So this is how you write asset beta. And from here, you can find equity beta, which is asset beta plus debt to equity ratio and the difference between asset beta and debt beta. As I said before, generally, debt beta is taken as 0. So this part will always be positive. And in that case, when you increase debt to equity ratio, equity beta will increase. Okay. And if you remember CAPM, do you remember CAPM? Really? Good. This is how you find the return on equity. you use some risk-free assets, and then you multiply the beta of the stock with the market risk premium, which is the market return, the difference between market return and the risk-free rate. So this was market risk premium. What is the risk-free asset in the economy? What do we use? So Treasury bill or Treasury bonds? 10-year bonds. For you, short term or long term? Pick one. Who says short term? Turagai. Okay, who supports Turagai? He says we need to use short term. Who supports Barto? Okay, you need to pick a side. Okay, Turagai or Barto. Who goes with Barto? Who goes with Turagai? Turagai, you're losing people. You're okay. I think Turagai is right. Why? Short-term bonds are less risky. In long-term bonds, we have interest rate risk. But in short-term,
Depends.
Okay.
In Greece case, short-term bonds were more riskier.
In what case?
Greece or Spain.
Okay, we are talking about extreme crisis expectation cases, but you're right. But in general, we know that short-term bills are less risky. Why? Because you can play with your investment easily when you have short-term investment. Think that way. So I think Turagai is right. We use treasury bills. And Adijan, you didn't change your mind, right? Oh, you did in the last minute. Okay.
No, I
so,
just raised my hand for. Yeah, I raised my. You can maybe vote.
No, but you were right first. You said T-bill. Then you converted. You shouldn't have. Okay. Yes, you go with risk-free bonds. The risk-free ones is we say that it's short-term bonds, treasury government bonds. Why it's not corporate bonds? Because corporate bonds have more bankruptcy risk compared to treasury. Although, Batu will say, oh, some governments go bankrupt. You're right, but in general, a corporation going bankrupt probability is higher, of course. Okay, so this is the CAPM formula, and market risk premium is generally taken as like 7%, which is the historical value. So if we use CAPM to link cost of equity to debt to equity ratio, this is what we're going to do. Instead of equity beta, we're going to plug the formula we just looked. So this is equity beta. The rest is CAPM. So again, if you play with things, this is where we're going to end up with. And this is something we saw earlier. So cost of equity is return on equity is return on assets plus some financial risk we add. Okay, so due to the increased beta, because of debt to equity ratio increase, we see an increase in return on equity. So this is what we just saw. Okay, finally, we're done with the basic case. For in the Modigliani-Miller, where there are no taxes and no bankruptcy, we have two propositions. One, you cannot change the value of the firm by changing capital structure. And proposition 2 says you cannot change weighted average cost of capital by changing capital structure. So what does it say? Capital structure. What does it say? Capital structure is irrelevant. Any questions about this? Anything we did? No? No. Okay. Okay, so if capital structure is irrelevant, why are we spending a lot of time on it? Why CEOs are spending a lot of time on it? Now we're going to show you we have other things to think about. We know that there is advantage of you using that. I love agency costs, so let's talk a little bit on it. So when a company has some debt, it gives some obligation to the debt to the CEO. So CEO will want to pay back the debt because if the CEO cannot pay back the debt, the company will be bankrupt, and no CEO wants their company to be in bankrupt. So in this sense, the CEO should behave, and the CEO should take better in projects to make the company worth more. So that's good for some companies having some debt. And if you remember from Tuesday, some companies don't have any debt whatsoever. I think Google doesn't have any debt. And you read about Facebook? We talked about Facebook on Tuesday, and do you know what happened to Facebook today? They bought WhatsApp. And there's an interesting story. It is in my, I put the link, it's in my email, but let me just tell you something. I think 4 years ago, one of the founders of WhatsApp applied to Twitter and Facebook to find a job. He got rejected. And actually, he put it on Twitter, like really, like 4 years ago. He said, "Oh, I talked to Twitter, they rejected me." In another tweet, he said, "I talked to Facebook today, and they rejected me. Oh well, it was going to be a good opportunity for me, but like, what can I do?" Okay. After 4 years, one of his friends said, "Okay, we're going to start something new." They start WhatsApp, and today they sold their WhatsApp for what, $19 billion or something, right? So it was big to Facebook. So guys, if you got rejected by a company, don't lose your hope. Okay, you might start your own business and then make them pay a lot of money for your company later. I think that's the best kind of revenge, right? Okay, going back to debt after a little life lesson. So debt reduces some agency costs. Instead of, if a manager has lots of free cash flow, he's not going to know what to do with that money. And managers have empire building incentives. They want to manage bigger companies. So just for the sake of making the company bigger, the CEO might go do lots of crazy mergers, like bad mergers as well. So if a company has debts, maybe managers will not do that because they have to pay back the debt. Another advantage of that, and this is what we're going to focus on now, is the tax advantage. We know that after tax cost of debt is low compared to cost of equity or cost of any other form of financing. And this is what we're going to see in the next slides. Okay, when a company has some debts, we talked about it last time. The company has to pay some interest, and interest payments reduces the taxable income. So it reduces the tax that will be paid to the government. Let's look at this example. We have this company, Safeway, which had earnings before interest and taxes of approximately $1.85 billion in 2008, and the interest expense of about $350 million. The tax rate is 35%. So now let's look at the income for this company in debt case and no debt case. So with some leverage, the EBIT was given. It is 1850, and interest expense is 350 given in the question. So taxable income is 1500. You pay 35% of it as to the government, so your net income will be 975. If the company doesn't have any leverage, 1850 will be the EBIT, and taxable income will be 1850. Look at the tax. The tax you pay is way higher when you have leverage, and net income will be 1202. So what do we see here? We see two things. With leverage, net income will be smaller. Do you think this company with leverage looks worse compared to no leverage case because it has less net income? I actually do a similar example in my corporate finance class as well. You remember it? Okay. So this net income goes to whom? Shareholders or debt holders? Net income goes to shareholders, right? The company can pay out all all this net income as dividends to shareholders. Okay, so let's look at this case. So the company has two kinds of investors. It has debt holders, it has shareholders. With leverage case, you return 975 to your shareholders, but since you have leverage, you're paying 350 to your debt holders. If you don't have any leverage, your net income is higher, 1202, but you're not returning anything to your debt holders because you don't have any debt. So together, you create 1202 income available to investors. Look at those two cases. Actually, when you have leverage, you're distributing more to your investors. It's just the kind of investors change. So here, you're distributing money both to your stockholders and debt holders. Here, you're just returning money to your stockholders. So just because net income is less in the leverage case doesn't mean that the company generated less money. Another thing I'm going to ask, or I will point out, is the difference between the net incomes. So the difference, oh, sorry, let me move there. Okay, so basically with leverage, this company paid $13.25 to investors. Without leverage, it paid $12.02. Look at the difference. There's a difference of $123 million. Where does this come from?
Tax.
Oh, thank you. Yes, we're talking about tax. It has to come from tax. And let's see how we calculate it. So we're going to assume something that will not be very realistic. So we're going to assume that this interest tax shield, interest tax benefits will go on forever. And this interest shield that you pay will be fixed all over the years. So basically, my assumption says that this is going to be like a perpetuity. So every year, this is the debt you have. This is the interest rate. So every year, you're going to pay this much of interest on your debt. And since we're interested in tax benefits, I'm multiplying it with tax. Since I assume this is not going to change, and it's going to go on forever, I'm using the perpetuity formula, if you remember it from corporate finance class. So you're dividing this over cost of debt. So these things in numerator and denominator, they kill each other, and you end up with this. So present value of interest tax shield will be equal to debt times tax rate. And in Safeway's case, the debt you have was $350. Tax rate was 35%. So $123 million is the present value of interest tax shield. That's how you generated more cash to your investors. You're taking away from the government and returning it to your investors. Clear? Straightforward? Perfect. Okay. So again, we're in the case where there's no bankruptcy, but I'm introducing tax now. Let's look at the simple example and then move to the propositions. So I'm going to compare two cases, unlevered company and levered company. These are the sales in each case, $1,000. These are the costs. It's the same. We have the depreciation. It's the same. EBITs are the same. In one case, we have interest payment. In one case, we don't. Assume that we are taking a $2,000 debt with 10% interest rate. So how much interest you're going to pay? 10% of 2,000. You're going to pay 200 as the interest payment. So what is my taxable income? It's 500 or 300, depending on whether you have leverage or not. You pay 40% of tax. So you end up with net income 300 when you don't have any leverage, 180 when you have leverage. Okay, the idea is same. What is the interest tax shield? Interest tax shield should be the difference between these two cases. How much tax you pay when you have leverage, how much tax you pay when you don't have any leverage. So the difference is what? 200 minus 120, it's 80. How do we calculate it using the formula I just used previously? So what was the present value of interest tax shield? Was what? It was debt times the tax rate, right? So do you see how much debt we have? 2,000. What is the tax rate?
4,000.
So multiply those two. present value of interest tax shield is 80. So I'm making a very basic assumption, but actually you see it here that it works. Okay? So this is the tax shield thing. So how is it going to affect Modigliani and Miller propositions? Let's look at this. Basically, for this, we again have a slice. If you don't have any debt, you pay some tax to the government. The remaining part goes to the equity holders. When you have leverage, you have less money paid to the government. You have some debt, and then you have equity payments. So again, you're looking at the same slice. But with the Modigliani-Miller case, when we introduce tax but no bankruptcy, this is how things will change. You will actually be able to increase the value of the firm by the present value of interest tax shield. Think about Safeway case, right? There was more money ready to be distributed to investors, which means more value. And in that case, the more value you generated, 123 million, was coming from present value of interest tax shield, which was simply debt times tax. So now you can see by increasing debt, you can increase the value of the firm. So what is the optimal debt to equity ratio? Who's going to say it? What is the optimal? In the previous case, there was no optimal debt to equity ratio because capital structure decision was irrelevant. You couldn't increase the value of the firm. You couldn't change the weighted average cost of capital. How about in this case? Yes, Tanash. True? Alper. Okay, it ended with ER. All that, right? You can, as much as that you can use is better for you because with more debt, you're going to increase the present value of interest tax shield. So you're going to increase the value of the firm. See, things change now. Okay. What is this? Does it make sense to you? Being an all debt company? Because of bankruptcy, this doesn't make any sense. But remember, we're in a world where there's no bankruptcy. So in this case, this is the optimal. Okay? Okay, let's look at another example. Suppose that we own a company. It's an all-equity company, PQR. Our stock is currently worth $50 million, and there is no debt. The company is considering borrowing $1 million at 10% interest and using the proceeds to purchase $1 million in stock from us, repurchasing stocks. PQR pays tax at 40% marginal tax rate. Okay, so we know that interest expense is tax deductible, and we know how to calculate present value of interest tax shield, which is here. So if I have $1 million debts, I will have, and 40% tax rate. So present value of interest tax shield is $400,000. So what was the previous value of the company? It was 50 million. So you add 0.4 million to your 50 million. So you increase the value of the firm by that. So it's going to be $50.4 million. I increase the value of the firm. 1 million is debt. So from that value, 49.4 million will be the value of the equity portion, which is bad for actually shareholders, right? They were getting 50 million, now it is 49.4. But since we use some debt, the company's overall value increased by $0.4 million. The idea is the same. You can increase the value of the firm by increasing debt, which will be a good thing if there's no bankruptcy in the economy. And if you want to see the graphical representation, this is how we're gonna what we're gonna see. As you have more debt, you're increasing the value of the firm. So optimal debt to equity ratio, use as much debt as possible. No equity, zero equity, all debt. Now let's look at proposition 2, which was about weighted average cost of capital. So when we have debt, things change a little bit. Pay attention, please. So this is weight of debt, cost of debt. Since we have tax now, I have to consider the tax advantage. So I have y minus t here. This part is the same. Weight of equity, cost of equity. Okay? So if we look at the weighted average cost of capital representation, it's going to turn into this. So this is the WACC of an unlevered firm. This is how that will affect things. So this part, okay, this part will be smaller than 1, right? Right? You all see it? This part will be smaller than 1. So WACC of the levered firm will be less than WACC of the unlevered firm. Do you see what's happening here? When you have leverage, you're decreasing your weighted average cost of capital. Is it a good thing? Is it a good thing? Yes. Because by decreasing WACC, you can increase the value of the... And this is what proposition 1 says. Use more debt, value will increase. They're saying the same thing. Okay. Ooh. Now let's move to cost of equity, another ugly slide. Okay. So here what we... I will actually not spend time on this, but let me just point out a couple of things. One, return on assets will be this. This is basically, EBIT times 1 minus T, so after tax EBIT over the value of the unlevered firm. And after that, value of the unlevered firm will be equal to value of levered firm minus the present value of interest tax shield. This is what you already know. This portion is new. That's the only new thing here. So if you play with things, I'm not going to ask you the derivation of those formulas, of course. But as an intuition, if you want to see where it comes from, it's in the slide. So we end up with something like this. So it's very similar to what we saw before, cost of equity formula. The only thing that changes, we have this little guy, 1 minus t. That's it. We thought that. We already saw this in the previous slides. Okay? So we're introducing tax. So what happens to our WACC representation? It's going to look like that. I know it looks messy, but it's nothing new, actually. So remember we said as debt to equity increases, cost of equity will increase. Okay, this is the previous case that we talk about. When you don't have any tax, this is the cost of equity. When you have tax, cost of equity will be lower, just math, and it will increase by increased debt to equity ratio. Cost of debt is still lower than cost of equity, but now because of debt, after tax cost of debt will be lower than cost of debt. Okay, therefore it moved down. And when you calculate weighted average cost of capital, it's going to decrease with that. The only thing that is saying is M&M proposition 2. If you increase debt, weighted average cost of capital will decrease. That's the only thing this graph is saying, actually. And of course, because of debt, the slopes of cost of equity, the slope of cost of equity change, and where cost of debt is shown change. That's it. Any questions? Okay, I'm fine with it. I'm fine with it. Oh, good. We have a couple of examples, and then maybe solving some problems will make things a little bit better or worse. We will see. Okay, the only thing before the problems, actual problems are about this. Let's look at betas when we have taxes. And again, the only thing we're doing is we're introducing tax to the picture. So the equation changed this way. We have equity beta, which is the levered firmed beta. We have asset beta, which is the unlevered firm. Or when you unlever the firm, this is the beta you're going to get, plus the part related to the debt financing. Okay? And from here, when I assume that beta is 0, this is how I can write things. It's the same thing. The only thing I'm doing is I'm I'm taking debt beta is 0. So this is 0, okay? And this is how things look now. So I have equity beta, and I can separate the equity beta into two things. One is the business risk. It has nothing to do with the financing. And then I have the financial risk part related to debt to equity ratio. So let me write this on the board, and then we can solve the question, and hopefully things will be a little bit clearer. So I have equity beta, which is equal to asset beta, plus the debt portion. Okay. Okay. So let's read this example, and let's look at how we're going to use this information to solve problems. Suppose GE currently has a beta on equity of 0.8, has 15 billion of debt outstanding, and has 75 billion in equity. If you're a little bit sleepy, just try to wake up. This is an important problem. You know, you have midterm after the valuation chapter. So there will be problems in that midterm, and I mean, this is going to be a very basic question, let's say, in the midterm. Very similar to maybe one of the midterm questions. So just wake up. What would happen to GE's equity beta if it issues 25 billion in debt and uses the proceeds to buy back 25 billion of its stock? GE's tax rate is 40%. So what am I going to do here? What am I going to do is that in all those questions, there are 3 steps. And let's try to understand the intuition. So here, there will be a change in the structure of financing. For that, the first thing I need to do is I'm going to calculate the business beta from the business risk. Why am I doing this? I'm basically unlevering the beta. So I'm trying to find the riskiness of the company if there was no debt. So that will be the first step. Why am I doing this? Because first, I'm going to take out debt from the picture. Then I'm going to introduce the new debt structure. Okay? So first, calculate the asset beta. And I will always use the same formula for that. Then I'm going to calculate the new debt to equity ratio. Simple. Then I'm going to use the new equity beta using the new debt to equity ratio, and asset beta I just calculated in the first step. So steps are very clear. And I think you got the intuition. Unlever the beta, just remove all the effect of financing, then plug in the new debt to equity ratio in the picture. That's all we're doing. And let me write this part as well. Okay, so it's the same formula, just representation is a little bit different. Okay, so what am I going to do first? What is the debt to equity ratio? Okay, so this company has 50 billion in debt, 75 billion in equity. So debt to equity ratio will be 50 over 75. Question, this is the old debt to equity structure. Tax rate is 40%, it is given. The beta of the company is the equity beta, 0.8. So from here, I calculate the asset beta, which is 0.57. So when you remove the effect of financing decision, this is the beta of the company, unlevered beta. Any question in this step? Perfect. The second step, find the new debt to equity ratio. So this says what? It issues 25 billion in debt and uses the proceeds to buy back 25 billion of its stock. So originally, let's write the original levels. So originally, debt was 50, equity was 75. Now things are going to change. So now the company uses more debt. So it's adding $25 million as new debt. It is buying back equity. Buying back equity means equity will shrink, right? So the original one was 75, you reduce 25 from it. So the new debt will be 75, new equity will be 50. Is this part clear? So you raised more debt to buy back equity. So you increased debt, you decreased equity. Okay. So the new debt to equity ratio is 75/50. Tax rate is still 40%. This is the asset beta. So actually this is using this formula in the common parentheses. Is this correct? Yes? Okay. So this is the asset beta from the first step. This is the new debt to equity ratio. So this is going to be the equity beta. You're done. Are we done? Yes. So if you want to see how much of this beta comes from business risk, how much of it comes from financial risk, we also know this. So asset beta gives you the business risk. Why? Business risk is irrelevant of the capital structure. Asset beta is irrelevant of capital structure. So this asset beta will give you the business risk, and the remaining 1.08 minus the asset beta will give you the financial risk, which is 0.51. So it is basically this part, 0.567, and this part is 0.5143. So this is the business risk, this is the financial risk. Together it gives you the total risk of the company. Is it difficult, you think? I don't think it's difficult. Okay, any questions? Okay, one more example then. This example is longer, and it might be a little bit more complicated, but I think we'll be fine. Everything will be under control. Okay, so suppose that we are the CFO of Amtrak. Do you know what Amtrak is?
Yeah, California train company.
Okay, you were very excited about it. You've been to California?
Yeah.
Okay, yeah. So it's basically railroads and bus. I think they have buses as well. Okay, as a CFO of Amtrak, you're deciding whether to build an airline division. You estimate the new division will return 17% on invested capital. So return, I'm thinking about an airline division, and the return on that airline division will be 17%. And the question I ask is whether I should open the airline division. Okay? So I'm linking financing decision to actually capital budgeting decision now. Okay, are you ready? Can we start? Okay, as a CFO of Amtrak, I have no idea about airlines. And I don't know the riskiness of it, anything about it. So what's the first thing I'm going to do? What do you do when you think about a new industry? You look at where?
Potential rivals.
Exactly, you look at your potential competitors and how well they're doing. Wonderful. So suppose that I have 5 different companies, A, B, C, D, E. I wasn't very creative about the names, okay? And company betas are given. You can find betas on Yahoo Finance, Google Finance, everywhere. Okay, these are the company betas. These are equity betas, okay? And I know the debt to equity ratios of those companies. So the first thing I'm going to do is, since those companies have different capital structures, first I will get rid of the effect of financing for those companies. So what am I trying to say? I will calculate the unlevered beta for those companies. The same thing we did in the previous example. I'm just increasing, I'm just looking at different firms now instead of looking at the same firm. So what am I going to do? I'm going to use this formula again. This is asset beta, which is equal to equity beta over 1 plus 1 minus TD over E. Tax rate was given 40%. So for each case, using this information, I'm going to find asset beta. Or, I mean, in your case, you're going to find those, of course. Okay, I will give you the question. You're going to solve it. Okay, you will find asset betas. Then what am I going to do? I'm going to take the average of those. So on average, what is the business risk in this industry? So just take the average. So the asset beta of those companies will be 0.584. So that's good. I have a starting point. In the second part, what am I going to do? I'm going to say, I don't know about my capital structure decision, but I need to introduce the financing decision in the picture because I don't know where the money will come from. So I use different debt-to-equity ratios for that. So I started with no debt, 10% debt, 20, 30, 40, or 50% debt. So all kinds of debt, basically, I tried. These are the debt-to-equity ratios. Okay? So this was the debt ratio. This is the debt-to-equity ratio. Is this part clear? So if you have 50% debt, you have 50% equity. 50 over 50 will be 1. Okay? Okay, this is how we calculate those. Then I'm going to find levered beta, equity beta. How am I going to do it? I'm going to use the same formula. I already found the asset beta in the previous slides, which is the average of asset betas of the companies. And suppose that as the CFO, I decided to use 20% debt. I don't know why. I decided to use 20% debt. Okay? You can use different things as well. With 20% debt, equity beta will be equal to 0.67. In the previous question, this is where we left. But I will take it to further stages now. Because now I will try to make a decision whether I should start the airline division or not. Okay, so this is the equity beta. Then what am I going to say? Okay, I know I'm going to use 20% of debt. But now I'm interested in the financing part. What is cost of equity? What is cost of debt? So suppose I calculated equity beta from, it is in the previous slide. This is what equity beta is. Okay. The treasury bonds return is 0.98. It's in the economy. I mean, we can find T-bond rates on the internet very, very easily. Suppose that it is around 7%. Market risk premium is 7%. It's given. I'm interested in cost of equity. Why I'm giving you this information? Because I want to use CAPM. In CAPM, do you remember what we have? We have risk-free rates, treasury bonds, plus I have the market risk premium times the equity beta. Don't use asset beta here. It has to be equity beta because I'm interested in cost of equity. Okay? So cost of equity will be 11.7%. What else do I need? I calculate cost of equity. Cost of that. Okay. So suppose that I look at the industry and I determine that since I'm not in the airline division, I have no idea about cost of debt of airline companies. And I look at other companies and I see that if a company, airline company has 20% debt, it generally has a rating of A. Who gives those ratings? Credit rating agencies, depending on what? Huh?
How credible you are.
It's all about how credible you are, whether you will be able to pay back the debt. And they look at like hundreds of different things, of course. But suppose that they're giving A rating to 20% debt airline industry. Very simplifying way of looking at things. And you know that A-rated bonds have a return of 7.74%. How do you know it? You can actually Google it and you can find it on some websites. So here, AAA companies have 7.5% debt, cost of debt. A-rated ones have 7.74% debt. B ones have 10.38% debt. Why is it increasing as rates go from AAA to B? They're riskier. Actually, companies with triple B and higher are called investment companies, investment bonds. These are junk bonds. The high risk you have, the higher the cost of debt will be. And YTM is also cost of debt. High risk means high expected return, don't forget. And basically, cost of debt is determined by the default risk premium and risk-free rate. And you found this after making all those research on cost of debt. So I know cost of debt as well, right? I found cost of debt to be 7.74% for A-rated airline companies with 20% of debt. So the after-tax cost of debt will be cost of debt times, oh, there's a typo here. This should be 0.6. 1 minus the tax rate. Sorry about that. So after-tax cost of debt will be 4.6%. Are you lost? Can you follow what we're doing? Okay. Ask me if you have a question. Okay. So you're using 80% equity, 20% debt. And I already calculated cost of equity using CAPM. If you remember, it was 0.117. So now I'm interested in weighted average cost of capital, which was weight of debt times after-tax cost of debt plus weight of equity times cost of equity. So WACC is 10%. What was the return you expected? Do you remember it? 17%. Would you take that investment?
Yes.
The return you hope to get is 17%. Cost of the capital is 10%. It's a good investment. You take it. So do you have any question about this particular question? I know you're tired, but just think about it one more time. Okay, so what we did was, let me just summarize. Every time somebody asks you about changing capital structure, the steps we follow are the same. First, find the unlevered beta. Why are we doing this? Because I'm removing the effect of financing, and I'm just focusing on business risk of the company or of the project. You can find the business risk just if you're taking an average project, like the GE case, then you can just focus on your own company because it's an average project. Nothing will be surprising. Focus on your company, like in our first example. In the Amtrak example, I couldn't focus on Amtrak because I'm talking about airline division, which is completely new. So for that, I look at the competitors. I found their asset beta. So I found their business risk. Then I decided on the capital structure. I said I'm going to use 20% debt. I calculated equity beta. Then I said I'm not done. I'm interested in the cost of capital. So I had to find cost of equity. I found cost of equity using CAPM. Then I needed cost of debt. Finding cost of debt is more difficult. So for that, I look at airline division companies, how their ratings are, and what is the cost of debt for those particular ratings. I found cost of debt. Then together, I used weighted average cost of capital. I found the cost of capital for this particular project. And since cost of capital is less than return on investment, it's a good investment. I would take it. So the last slide is the summary of the thing we just saw. In Modigliani and Miller world, with no tax and no bankruptcy, you cannot change the value of the company. It was fixed. We didn't have this. Value of a levered firm was same with value of unlevered firm. And weighted average cost of capital for the levered firm was same with weighted average cost of capital of the unlevered firm. When I introduced tax, no bankruptcy, but tax, I was able to increase the value of the levered firm by increasing debt because of tax benefits. So I'm adding present value of interest tax shield to the value of the unlevered firm. So optimal debt to equity ratio is infinite number of debt. And in the proposition 2, you were able to minimize weighted average cost of capital by using debt. And this is how you maximize the value. So that's the summary of what we just saw. So have you found the money machine? No. Next Thursday, we're going to introduce bankruptcy to the picture. As you have more debt, you will be in trouble. That's it. See you next Thursday.